Hey everyone, another webinar here. And this one, I'm really pleased to have Clifford Choi. And Clifford is one of the best in the business at explaining reverse mortgages and why they're essential in today's market. Thanks for
Thank you.
joining me, Clifford.
No problem.
So, markets are challenging right now. People are needing more money. So I brought Clifford in to talk about reverse mortgages. So maybe you can give us a little explanation on what exactly a reverse mortgage is for people who are not quite sure.
Okay, reverse mortgage technically is what I call a hybrid line of credit. Is what I call a non-revolving and no monthly payment account that people will get access of the money through the home to help them to conduct day-to-day. Obviously, there's interest rate incurred on there. However, there's a big myth that a lot of people are not truly understanding reverse mortgage. In current market, there's three products that are being secured against by the property.
Okay.
Most of us know is mortgages
Yep.
and line credit.
Right.
Now, the typical characteristic on a mortgage is that we'll say that mortgage have four characteristics. One is that you need to use up all the money in day one,
Yep.
right? You need to have a monthly payment. And when you pay back down your mortgage, you cannot reuse that money again.
Non-readvanceable.
It's not realizable.
Yeah.
And technically, because we have private mortgage in the industry, so you actually don't really need income to qualify for a mortgage. On the other hand, that most people are very knowledgeable on is a line credit.
Yep.
So the beauty about line credit is that the line credit is an account that gives you a limit that you can access at any given point in time. You don't need to use up all the money in day one. However, whatever amount you use, there's interest incurred and you are subject to making payments on those interests. So there's a payment involved.
Yeah.
And then when you pay back the line credit, you can actually reuse the money again. That's the beauty of line credit. However, the line credit, you actually need income to qualify. So as we talk about this two product, I add the third product right in the middle, which is technically where that place will be the reverse mortgage, which I really call them the no payment, non-revolving account.
Okay.
The traditional myth is that a lot of people feel that when they apply for a reverse mortgage, they need to use up all the money in day one. That's one of the common myths that we always hear. But in fact, our product is a line of credit based product that when we give an approval, you don't actually need to use all the money in day one. So really, I cannot call myself a mortgage.
Right.
But on the other hand, that if you pay us back, I cannot allow you to reuse the money again. So I cannot call myself a line of credit either.
I see.
It's kind of a hybrid right in the middle.
It's a hybrid.
The good thing about us is that, again, what I'm saying is right in the middle because both of the two products, you need to make a regular monthly payments. However, for us, we don't force you to make monthly payments. Hence, you are in more better control for your own finances.
Right, so you kind of touched on demystifying reverse mortgages here. And me as a mortgage broker, I've always advised clients to take a home equity line of credit before they retire because you never, even if you have a free and clear home, because you never know where you might need it. This is for clients that may have a free and clear home that don't qualify.
Correct.
Right, so when we talk about demystifying, you touched on the difference between the three different types of mortgages. What other things that do you hear that are misconceptions about reverse mortgages?
So,
one is you don't need to make a payment,
right?
Obviously.
So I think one of the biggest concerns is that first I want to take a step back on there by asking you then, mortgage. The term mortgage, other than stock mortgage itself, does it mean it's the exact same product around different part of the world? Like a U.S. mortgage compared to Canadian mortgage?
Similar aside from terms, the U.S. is 30 years.
Right, so we cannot really say they're exactly the same, right?
Yeah.
There's no difference on that on reverse mortgage, right? Reverse mortgage is basically a name. A lot of people feel that they're exactly same and identical product on our close neighbor U.S. And I want to point that over to that is that U.S. is based on the state law. New York State have their own terms and conditions of reverse mortgage, And California state have their own state in terms of reverse mortgage. So you can really compare the US reverse mortgage directly to us. And as I said, reverse mortgage is not a new product. It has been around the world in England, in Japan, in Asia. They have that in that, but they bear the name of reverse mortgage, but they function differently.
Okay.
So that's one of the big myths that I think that we have seen a lot on there. To be clarify that, Canadian reverse mortgage is what I called earlier a no monthly payment, non-revolving account, which are totally different than our neighbor's reverse mortgage.
Good.
And I think the other things that a lot of people feel about the myth about reverse mortgage is that I will lose the ownership of the house. I think that's one of the biggest things out there.
It's all the time.
And it's always on this kind of
property,
right? We actually give the control back to the clients when we talk about this. Think of that. We think we're in control then.
Yeah.
We think we're in control, right? And I think that I have a mortgage, you have a mortgage then, right?
Yeah.
What if, think of that, you have a mortgage with say RBC right now. Touch wood, something happened to Clifford, I got a mortgage, I'm a single income earner, and if I actually pass away, what actually happens in today's market and my wife have no income? Am I in control? No, the bank is in control because if my wife is not able to make any payments, now my wife have to struggle to do what? To sell our investment, if we have insurance payout, if nothing is enough to cover, she's now going to force to sell the home. But if the client have a reverse mortgage, if I have a reverse mortgage, and that scenario is on there, that if I pass away, my wife don't need to requalify. Now she's in
Doesn't she have to be a certain age?
Well, she have to be in 55 plus.
Right, okay. Okay, so demystifying, the biggest one that I hear is like, I think I'll own my home, and it's really basically works like a regular mortgage.
Yep, it is totally.
So let's get into how it works, how you qualify. It'll kind of help answer the demystification process. Right?
The qualification is no different than what regular bank mortgage have to be. We actually have to somehow, because we're governed by house fee,
Yep.
we somehow have to show the client have the ability to handle the basic payments such as property tax, insurance policies.
Yeah.
The good thing about us is that we don't ask for payments. So most of the retirees have the income to qualify for the payment of property tax and home insurance.
Right.
And with that, 9 of 10 times, or 10 of 10 times, we qualify because we do a property
Right,
tax.
so basically you're coming to a mortgage broker like myself, you can go to some of these lenders directly too, but you come to a broker like myself, we look into your application, we make sure there's at least the basic necessities to pay for.
Yep.
We submit an application, and it's basically like a regular mortgage.
It is.
right?
It is like regular mortgage, and we have our own requirement for
Yeah.
the client to hit into certain.
So let's go, so how it works is application, submission, comes back with an approval. Maybe we can talk about the, not only the process, but what are the rules that are requirements for, because it's not really a mortgage per se, there are some age restrictions.
Yes, absolutely.
Right, so we need to get into that. a little
Right.
bit, right?
In order for us to qualify, or in order for a customer to be able to qualify for reverse mortgage, is that both husband and wife, whether they're on title or not on title, need to be 55 plus years old.
Okay,
That is the bare minimum.
yeah,
Say if your spouse is 6 months behind to be 55 years old, can I do a deal for you right now?
No.
Sorry, cannot do it, right? And that is how we do it. We base it on age totally, and each age segment will actually give you a different amount of approval.
yeah,
The younger you are, the less we approve. The reasons why being so, because in reality, we want to make sure the client have leftover equity
yeah,
for the estate, right? We don't want to eat up everything's on there, so that's why how we decide is that it's based on age. The younger they are, the less amount we give. However, the older they are, the more
more
we
than
give.
you do.
So, and the good thing about us is that you can continue to refinance. When the house value go higher, your age go higher,
Yeah.
and you feel the amount that we gave you original is not enough, you can actually reapprove and reapply to get you more money out for your house to cover that.
Right, okay, so number one is age, so obviously 55 years and up. Then there's a matrix of how much you can borrow at
Correct.
specific ages, it's on the value of the
Correct.
property.
It's all appraisal valued.
3-4 weeks, you can do this type of
Pretty
process.
much you're talking about 3 to 4 weeks times
Right.
that you can pretty much get all set, providing that we have all documentation up front.
Right.
You know, how fast can we close a deal? We actually can close a deal within 14 business days, so which is quite fast.
Right, so I want to touch back on the demystification. So it's not a mortgage, so there's no payment required. So we get your application in, we get an approval for the amount of money that, obviously the mortgage is entitled to. But then there are different ways that the client can take out that.
Correct. So there is a couple of ways the client can access the money.
Because it's not something that you need to take up front, like a
Absolutely,
mortgage, right?
because if you remember, it's what I call a no monthly payment,
Yeah.
non-revolving account, but we don't need the client use up all the money day one. So the client have the options. So the two common options that we see client utilizing is that they could take a chunk of money out to pay off their existing balance on the mortgage.
Right.
Now,
Well,
because-
first, it has to be a first mortgage.
And we have to be first
So we
mortgage.
need to pay that, if there's even a small balance,
Small
we would need
balance.
to pay that
Right.
on your house.
And that is a very good thing for people to know, because a lot of people feel that if I need to do a reverse mortgage, my home has to be free and clear. That's one of them, other myth that
Yeah.
they think. But technically, no. As long as we could be in first positions,
Yep,
say we can approve the client for $500,000, if they owe $100,000 in mortgages, we'll take off the $100,000 to pay off the existing mortgage.
yep,
Instantly, by doing so, we will increase the cash flow for the clients.
yeah,
Because traditionally, you have to still make $500 or $600 payments
Yeah.
on that mortgage.
more than that, for sure.
That in today's rate, right? But now we clean it up.
Yeah,
So now we immediately increase the cash flow for the client. So now if you don't need to do that $100,000 mortgage payment, now you get extra money in your pocket for you to overcome your rising living costs.
yeah,
And now you still have the remaining limit for the client to access whatever they want. For example, if you want to buy a new car, they can just draw the money up from there, pay $30,000, pay off the car. Now, on the other hand, this is the traditional way of accessing the money through a regular reverse mortgage. On the other hand, if you say that if a client do the budget and they have no mortgage and that they feel that, you know what, my budget is about $1,000 short
yeah.
from what I
Which
can
is happening a lot more.
which is happening more now because everything's go higher. What we can now do is that our company can dispose $1,000 every month. Think of this in an annuity. It will go into your account, $1,000 every month to compensate
Yeah.
and substitution on your daily expenses. If you feel you need more, all you do is just we can call us and increase the amount.
Yep,
If you feel that, hey, you know what, I may not use that much, you can always reduce it. So it's not a carved in stone that you are stuck with that amount that you
Okay.
choose. So that's another way of accessing money.
so you can take a lump sum to do with what you want, and we've had clients that take a lump sum to help their kids with something, maybe buy another property.
Yeah, that could be a thing.
It's a way to do it. You can take it to alleviate some of the financial pressures.
Yeah.
By monthly, you can do it, can you do it quarterly?
Yeah, we can do quarterly, we can do monthly. And we also have clients utilizing that same money to buy a property down south
Right.
for them to be
For
snowbird, right?
retirement,
So
snowbirds.
retirement, so we've got snowbirds,
Yeah.
so we've got, people who live in a home in Toronto worth $2 million, have no mortgage on there, and they cannot get financings in the States to buy property, right? So they take $1 million, go down to the States, bought a condo, live happily, rent the place out while they're in Canada, same things.
Right, okay, so not traditional in a sense that you can take money out like an annuity, as
Yeah.
Clifford said. You can do it quarterly, you can take a lump sum to do with what you want. Some banks ask us where lump sums are going. There's no real questions on when.
Yeah, technically we still have to, because we want to protect the clients.
Yeah.
So we have seen a lot a high rising in fraud, like romance scam.
Yeah.
So we do as a bank, we protect our client. So we do ask. So don't get me saying that way.
Yeah,
There's no question
for
asked.
sure.
We still have to protect our
Yeah,
client
and
because
we have to do it as brokers
Right.
too. We wanna make sure that.
right. So
the
we've seen
client
that
is not
happen on
getting-
the rise. So we want to make sure that the client's not in pressure of something.
Yeah,
So we don't ask questions on it, right?
right. So do you see, down payment, gifted down payments, things
Yes.
like that?
So another myth that they thought a client have to own the home in order for them to get a reverse mortgage. But in fact, we have buyers or we have homeowners that they sold their homes and they want to buy a new one. And the down payment could be gifted from the kids,
Okay.
right? Some people have been rented, some like different cases are on there. So we actually you don't actually need to get a reverse mortgage provided you have a home. You can actually purchase a home and we can provide reverse mortgage no different than a regular bank mortgage. So let's use an example. If a client say that we can give them a reverse mortgage of $500,000 and they want to buy a home for $1 million. So what it does is that the client needs to supply us with $500,000 as a down payment that we qualify.
So you can do it for purchases.
Correct. So and then we give the down payment.
Yeah.
Could be the kids.
Yeah.
Combinations, their own money, kids. As long as you can show the traditional way of down payments proving, then we're good to go.
Right.
So not just only on our contract state very clearly that we do not charge you for mortgage payment. So when I'm saying that I don't charge you for mortgage payment, what does that mean? I really don't have any right to power sales of your house. Because think of a regular mortgage. If you don't make payments, they have the right to come and power sale your house, right? But on top of that, we allow the client to make interest payments if they want to.
Okay, so client could make interest
Correct.
payments, could make no payments.
Could make no payments, so the standard is no payments,
Standard people with no payments.
right? And then they have the right to set up a payments for themselves on a regular basis.
Yeah.
And the amount can only be up to the maximum interest being charged on the amount they have used.
Okay.
So say the interest charge of that mortgage client is $700, the maximum amount that I allow the client to make a monthly payment is $700.
Yeah.
However, we allow them to make a lesser payment than that. So if they want to make $400 instead of $700, that's
Right.
fine with us too. But that's how the payment works.
Okay.
On top of that, on the anniversary months, the clients are allowed to make additional 10% lump sum payments to pay down the mortgage. How this will apply is that we'll apply all the current interest owing on the mortgage before we apply any towards the principal.
Okay.
Okay, so everything will apply to the interest owed first before we apply to the principal. Now that is a traditional situation when the client have that. Now when you also ask when that eventual payback is very simple. At the cost of death,
Yeah.
or client decide that I don't like this property anymore
Wanna sell it.
and I don't want to sell it, very simple, traditional methods. As I said, we're a bank. All it does is the lawyer will cut a check to pay up all the interest incurred plus the amount you use, and the remaining differences will give it back to the clients.
Right.
Now touching on this, I think that another common thing that a lot of people are not aware of that, what if there's a market crisis? What if I outlive my house? One of our clients is 109 years old.
109. Wow.
So
Okay.
we are not age discrimination on it. We have a client who's 109 and still getting reverse mortgage. The reasons why being so is that she's very healthy. And she still wants to stay in the home, but the problem is that now because of her age deteriorate, she doesn't want to go to a long-term care facility on there, but now she needs a in-house nurse to
Yeah.
compensate that.
Yeah.
Pay for that. Well, the kid's not even come up with the money.
Sure.
However, because remember, 109, how old were the kids?
Yeah.
They're in the 80s and 90s, they're not income
Yeah.
earners anymore, right? So now the house is paying for that nurse to stay in with them, right? So that's why we give that.
Okay, again, before we start talking about taxation benefits of reverse mortgage, we also want to talk about, growth.
Right.
So growth, like everybody thinks reverse mortgage, when you start talking to them, well, it's interest only and my interest accumulates and I'm deteriorating my equity. We also have to factor in growth in whatever neighborhood area,
Correct.
city, province you're in. We have some unique tools that are available for us to show based on traditional market trends, how, your income, it's not your income, but your growth kind of offsets the interest
It does,
payments,
it
right?
does, it does. So, I think before we step into that, there's not really, it's scientific, I would say, because traditionally we got clients asking us, hey Dan, how much is my house going to be worth
Yeah, it's not
5 years from now?
scientific, who knows?
Right?
We can't-
No,
we
not
can't-
really
yeah.
know that, right? And a lot of
Nobody
people
knows that.
talk to realtors, everyone have a different perspective. They will always give you a very speculative answer. You know what? as you know, we got new immigrants coming in, we got shortage in housing supply, guaranteed the housing market is going to grow, right?
Yeah.
That's very vague. We
Very.
agree, right?
Very.
On the other hand, I'll just give you a more easier approach for people to understand. I'm not talking about 8% return, I'm not talking about 10% returns.
Yeah.
We're going back to the basics. So I'm going to ask you questions then is that Home Depot give a raise to the workers, 3 to 4% raise every single year.
Yeah.
So the question over to you is then, who actually paid for that 3 to 4% increase on wages? Home Depot does, or the consumers?
Consumers, prices are going up 3 to 4%, at least, if you believe.
Absolutely, right? So this is how I give you the more scientific way
Yeah.
of looking at
Yeah.
a home growth.
Yeah.
No immigrants coming in, no housing shortage. Just on that, as long as Home Depot workers, unless they replaced by AI, is a different story, right? If they're not replaced by AI, we still need workers who work at Home Depots, right?
Yeah.
Technically, they should get 3 to 4% raise every single year. Otherwise, they're not on strike or whatever. But I mean, that's kind of the
Yeah.
natural things on that. So as long as people get that raise on theirs, your home is going to get a raise 3 to 4% every single year,
Yeah.
guaranteed. That is where how I give you the more scientific
Right.
ways
Yeah.
of writing numbers.
So if you look at inflation rates, if you look at long-term home appreciation rates in your area,
Yep.
again, no scientific and disclaimer on, if we do something and show you,
Yeah.
how much your home is worth, but we do have some tools that can show you how much interest and how much your home growth
Correct.
will go up to cover.
Yeah,
at least-
and especially one thing is that when we talk about home growth, right? Your property then is not going to lend you the full value of your home, nor do we. So
Right.
remember one thing. So we're talking about, say your home worth $1 million. We'll only give you maybe 100,000, maybe 200,000, maybe 300,000, ranging around that range.
Maximum you're
maximum.
given.
So think of that. $1 million worth of a home of 4% growth give you how much? 4% every year, as I said, give you $40,000.
Yeah.
The interest rate we're charging is around 7% interest rate.
Yeah.
Now that's today, right? Obviously, interest rate going to go up and down, but we just use an example of
Yeah.
today, say 7%. So if you're looking at 7% of $300,000, it's only $20,000.
Yeah.
So what does that really mean? Is that not just only you're still able to keep your home
Yeah.
with the very basic growth potential. I'm not talking about 8, 10%. We're just on 4 right now.
Yeah. Yeah.
You're still able to take home
You're still
$18,000,
you're still taking, yeah,
right? You're
you're
still
still,
taking money out of that.
yeah, you're
right?
still participating in the appreciation.
Correct.
Not having to make payments. It's still long-term, you're.
And the good thing about that is all that money is tax-free money.
Yeah, and we're gonna get into taxation now, which is very, very important. Things have, as we said earlier, things have gotten way more expensive.
Correct.
Property taxes are going up and will probably continue to go up because governments need the money and real estate sales are lower, right? Food inflation is higher than the 4% inflation rate, it's probably 8 or 9. Everything has gone up. So we are looking, as mortgage brokers, we're not only helping you get a mortgage, but we're also looking at taxation strategies and working with our accountants and our financial planners to help you develop a cohesive plan. So let's get into taxation because home equity loan is tax-free.
It's tax-free.
Right? So we're not asking you, and you don't have to break your RSPs and things like that early to help you cover these expenses that are obviously going up for you. So let's get into taxation.
So disclaimers, obviously, I'm not an accountant.
We're not
right? We're not accountants.
We give mortgage advice. I'm governed by FSRA for being a mortgage broker, but we do understand taxation a bit. And I always say speak to your lawyer, speak to your accountant when it comes to that. But we do have some common sense, and things are getting more expensive, and now there's new taxes being implemented, and capital gains tax changes. So let's get into taxation and how this affects.
I think one of the big things I'll just use a very I call it dummy 101 taxations, right? We use something very simple things that we quickly talk about, a few items that we all need to be aware of. RSP is one of the most common things that people talk about. A lot of people feel that RSP is tax-free money, but in fact, everyone know that RSP is not tax-free money, it's tax-deferred money. When I'm saying tax-deferred money is that whenever money you draw out from RSP in any given days, it classifies as income and it is 100% taxable. No difference than a bonds, no different than a GIC term deposit interest rate. Any amount you drain out from there is tax deductible at a 100% rate.
Yeah.
So give an example, if you draw 300,000 out, it will actually bring you in the highest tax bracket.
Yeah.
What does that mean? That means 53% of that money taken from the RSP are now subject to tax, which is 170,000. That's quite a bit of money then, right?
Yeah.
No different than interest earners. The next things we come into there is what we call capital gains, right? Capital gains, we have a new potential things going to happen. We're not going to talk much about that right now, but technically right now in today's, in the current timeline, before June 25th of 2024, you're subject to be 50% tax on 50% amount you hold, or you gain, right? And with that, that's roughly to be about a quarter, about 25%, that's what we're talking about.
More efficient to have capital gains.
Correct, in comparison to that. So that's one of the things on all that. So in today's world, the old way of how retirees, without any help of any financial planners, more people would just start draining the money from the RSP first.
Yeah, makes sense.
Again, as this come into place, remember one thing I talked about, the more money you draw, the more tax you pay.
Yeah.
Now I talk about that quite a bit in a lot of my presentations, about a lot of people feel that when they retire they use less money. Would you agree with me on that?
No.
That's absolutely right then. Because the thing is that when we're looking at retirees is that
you make less money.
You make less money.
You're still paying the same bill.
Pretty much pay the same. And plus, one of the things that I talk about quite a bit of times in this podcast is about control. Most of the retiree tends to overspend during the early retirement years.
Yeah.
When they overspend in the early retirement years, what does that really mean in the aftermath? Well, the aftermath is that my health may not be on my side. In today, the actual healthcare system costs about $5,000 a month on living in private care. See, that is the low end.
Yeah.
High end, you probably hear something around $10,000, $15,000 a month. So now, by the time if you're at that age and you need long-term healthcare or any of those healthcare systems, will your money be enough to cover that? That's become one of the big things on there.
Sure.
So we now talk about more how to help you control and plan for your longevity of life. So what we talk about right now is combinations. We tell our client that if you think of your retirement income during your early years, say is $60,000. So we said that I'd rather you not drain out $60,000 all from the RSP. If you drain out $60,000 out from RSP, you may be in a 30% taxation.
Yeah.
But if you can control the amount you draw from your RSP, say 15, 20,000, you may not pay a lot of taxes, you may pay 10% taxes.
Yeah.
And then you compensate the differences utilizing your home to supplement.
Yeah.
So now your RSP will be able to stay longer,
Yeah.
less tax, grow more for you. It's no difference than your home. The longer you keep your home, the more value you can earn from there. That's what I call a combinations of retirement plannings.
Right.
Don't go with the traditional ways.
Right, so we're combining your retirement savings, your any pension you may have with equity in your home. And again, we're going to defer to accountants with this, but certainly it becomes more of a tax deferral strategy. It helps you keep your home plus keep money in your pocket when you're not struggling on day-to-day bills. We've been taught, I don't have a free and clear home, but many people in Canada, it's a big segment of our population, has been taught to pay down and pay down and pay down, but it's great to have net worth of millions in homes, but if you can't access it, then
It's
what good is
useless,
it, right?
Exactly.
Like, you're taking money from your investments that are gonna be taxed at high rates, rather than taking money from your
Yeah.
home, which is not taxed.
Yeah, remember one thing, Stan, right? If you, traditional way of that, when we have no money, what we do? We sell a home.
You sell a home and then you're sitting on money. and-
Right, you're sitting on money, but
But then you have
remember
no
the
home.
taxations. Remember the taxation part of it now?
Yeah,
Say you sell your home for $2 million. What are you going to do with that $2 million? Most of the people will put in a bank for term deposits.
Yeah.
And all the interest you earn are now
tax.
taxable.
Yeah,
So that's one of the big things a lot of people are not really understanding. Again, you have to understand taxation to help you plan for your retirement.
yeah,
Because with taxations, we just need to be smarter on taxations on it. Because one, as you said, if you sell a home, you have no place to stay, what does that mean? You have to pay rent.
yeah,
Rent will be in your investments.
yeah,
And the interest you earn on your investment are also taxable.
yeah,
Right? That's a big impact on that. Plus, if any client have more than $75,000 in any given year in income, government claw back the OAS. If they have $129,000 income, they have $0 OAS. So think of that.
yeah.
It's a double whammy, right?
Double whammy.
You got interest you earn now. Hey, the government say you're too wealthy.
Yeah.
Take away a little bit of your OAS.
And all the money you paid into it.
And you pay into that, right?
Right.
However, if you're able to maintain your home and as long as you keep your home under the current
Yeah,
taxations, you get 4% growth tax-free every year, minimum.
yeah,
Because Clifford teach you that 4% growth is how we evaluate
Pretty
your
much,
growth of
yeah.
home,
Yeah.
tax-free money. All I'm saying that utilizing that tax-free money to subsidize.
yeah. So we're looking at, so on top of it being an alternative to a mortgage or a home equity line of credit, it's also tax,
Tax-free money.
tax-free money, advantage, keeping you in your home longer. You don't have to, pay the exorbitant fees of
Absolutely.
other, senior homes and things like that. Allowing you to enjoy life because you've spent all your life paying off your home.
Yes.
And now you have all this equity, taking money out tax-free to not only just make the bills, but enjoy, the fruits of your labor
Yes.
for 30 years, if you've had a mortgage for 30 years. So these are all benefits to that. And the number one, I think, as a mortgage planner, is the tax-free benefit of it.
It's really
It's
impacting.
It's really, really impactful as taxes go up, especially in our country.
Yeah.
They seem to be going up, they never go down. We need strategies to help us get through the day-to-day life, right? So I do think it's worth conversations. We can talk to you, help you navigate this, speak with your accountant at the same time to make sure that you're fully aware of how this all works. But, the biggest thing is to live your life and enjoy it. Right?
and your own terms.
On your own terms, stay in your own home, place you love. So now, we've gone through demystifying, we've gone through taxation, we've gone through growth, all of this kind of stuff. We want to talk about the potentials to downsize and combinations and things like that.
Okay.
Right? So let's get into how we can maybe, if a client decides they want to sell, but we don't want to put all that money into a term deposit now and pay tax on it, what are different tax efficient ways of downsizing?
So here's a very, very good segue into that. Again, we focus in this taxation. Remember one thing on that. When we downsizing is a undeniable fact that eventually one day we're going to downsize. And the common things that people said, oh, my house is too big for me.
Yeah.
I need to move to a smaller home. But a lot of realtors tends to always help the client to sell a big home and move to a small home. At the same time, the value of that home gone down,
Yeah.
right? This is the message I'm driving more in today's world is that whenever you consider downsizings, the first things or you should talk to your realtors about a different alternative because remember, the taxation is really impacting. I'll use an example. If your home worth $2 million then, right? And when you sell that home, you have $2 million cash on your hand and then the realtor help you buy, say, $1 million nice condo downtown.
Yeah.
Now you literally have $1 million cash on
We're
hand,
filming this in Toronto, so.
right? So we use that in that, right?
Our $2 million homes in Toronto.
Right, in that, right? So now you got $1 million cash for that client sitting on their hand, 60, 70 years old. No one's really risky enough to put into high risk stock, right? Most of the time we put into term deposit. And if you recall what we just talked about earlier, money is staying in the banks, 100% taxable.
Yeah.
So what we're saying is that,
And all the the free money that you receive now becomes
become taxable,
taxable.
right? So we now, when saying that, is that whether you like it or not, you should replace, whenever you do downsizing, you should replace the value of your home equivalent in 2 or more properties. One for you to live, one for you to invest, because if you recall, capital gains investments are taxed differently than your GICs.
Okay, so let's drill down into this. So you're suggesting, which is a very good suggestion, which a lot of people are now considering, is that if they want to downsize, again, we'll use 2 million or $1 million, whatever that is, you buy 2 properties.
Correct.
To make your taxes efficient.
Yes.
One would be
Your principal home,
principal home,
which
which
is
is
tax-free.
not subject to taxes. And a second one you could buy outright.
right?
Right. That will be subject to capital gains, which we will touch on briefly. Again, we don't want to make this a tax,
Yeah, tax.
tax video.
Video, yes.
But capital gains are taxed much more efficiently
And less
and
than
less than
cash.
100% income.
Which is taxable interest rate.
So let's touch base on that.
So obviously, as you said, most of the people, as I said earlier, most people have $1 million sitting in the banks. All the interest you earned, say you earn 5% interest rate. 5% of $1 million is $50,000.
Yeah.
That $50,000 is classified as 100% taxable income.
Right.
That go against the client's incomes.
Right.
Now, on the other hand, if you do not sell your property, there's no capital gain tax you need to pay until the day you sell.
Yeah.
Right.
Right? So interesting strategies where before we used to call it progressive downsizing, where maybe you buy that.
It is still progressive
It is
downsizing.
progressive
It's still progressive
downsizing.
downsizing.
It is, but
Right.
before we were just saying, hey, let's sell and buy another one and we'll rent it out for a while until we're ready to move into it.
Right.
Now it's more of a suggestion if you're deciding to sell, you're buying 2 properties
Yes.
with that money.
Yes.
To really stretch your money even
Correct.
further, right?
Yes.
Rather than put it into the bank and get your 5%, but then get taxed on it. And then we're back to the same issue of being in a new tax bracket because you're getting, your money on
Yeah.
right?
Yeah. So accountant is definitely the best way to go.
Accountant is
So you
somebody-
always go talk to your accountant if you're making any decisions and all that. I think Dan is knowledgeable, and I think he has financial planners, all different people you can refer you to, and you can talk about, right? So
Yeah, so we're always gonna defer to your accountants, especially as, the money gets, larger and we're making those retirement plans and, you've gotta project how much you
Correct.
need over the, the
Yep.
course of your life, especially when you're downsizing. Or when you're leaving work or retiring or what have you, how are we gonna make it to a certain point in time?
because currently, I think
We're all living longer.
We're all living longer. The average age right now, as of today, is 82 years old for male.
Right.
Females, 90.
Yeah.
So I heard a stat was saying that people who born in after the millennium, after 2000, they have a chance to live over 100.
Wow.
So do the math on that.
Do the math. So we need to figure out the most tax efficient strategies to make your money last longer, to help you enjoy also. Like obviously there are people that are struggling and need this money to help them just get by day to day. But there are also people that, have worked their lives to pay their mortgages and now need a way to, access that without moving.
Yep.
Right? So we're providing that also. So reverse mortgage, sometimes there's some, misconceptions on it. I hope that Clifford and I have, answered some of those misconceptions. Again, it's always best to speak to a professional. I'm well versed in these. I've done many of these. I'd love to have a chance to talk to you. Clifford has been invaluable. He helps me structure deals. We'll be able to answer any questions that you have, but feel free to reach out. It's just a phone call. We can do some of this modeling for you in terms of appreciation and what it's going to cost you over the lifetime of mortgage with a home equity bank or any of the reverse mortgaging providers. But certainly it's something to consider. We didn't really touch on this, but rates are similar to a line of credit rate.
It's actually lower.
It's actually lower. So if I was today, when I tell my clients sometimes to get a line of credit for their property if it's free and clear before they retire, because it's the only way to qualify, those rates are higher than actual reverse mortgage rates.
Yeah.
Right. So this is even a better strategy, could be a better strategy than that, because you're not forced to make any payments. The interest is lower. So certainly good options. I hope we've demystified reverse mortgages for you. Thanks again, Clifford. I really appreciate it. It's great.